Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Welcome to the Global View on this Friday. Well, the European Central Bank has raised interest rates by 25 basis points. Its ninth consecutive hike, taking the deposit rate to 3.75%, its highest level since 2000. The central bank remains worried that price growth could be perpetuated by both rising costs and wages in an exceptionally tight jobs market. When asked about future policy, ECB President Christine Lagarde said there is the possibility of a hike. There is the possibility of a pause. It's a decisive maybe. Well, the US economy grew faster than expected in the second quarter as a resilient labour market supported consumer spending. Gross domestic product increased at a 2.4% annualised rate last quarter, compared with a 2% pace in the previous quarter. The personal consumption expenditures price index, which excludes food and energy and is closely watched by the Fed Reserve, advanced at a rate of 3.8%, which was the smallest gain since the first quarter of 2021. Meanwhile, the number of jobless claims fell last week to its lowest level since January. US Treasury yields, they gained on that solid economic data, prompting expectations that the world's largest economy may avoid recession. Two-year yields hitting two-week highs of 4.95% and the 10-year just over 4%. The US dollar has strengthened. Meanwhile, the Japanese yen also strengthening. On a report, the Bank of Japan will consider tweaking its yield curve control policy at its meeting today. And the Aussie dollar trading around 67.1 US cents. Well, a little earlier, I caught up with Tony Crescenzi from PIMCO, who shared his perspective on issues surrounding central banks and the global economy and how that is determining his outlook for fixed income.
Well, there's a lot to talk about, a lot to quibble over, whether the ECB, the Fed will deliver no more hikes, one, two more, who knows how many. But it's all water under the bridge in a sense, because it looks like central banks are probably close to the end because we see some things breaking in the global economy here and there. Of course, the U.S. banking system, the problems it had in March would be one example. The weakness in the U.S. housing market, where housing construction has been down for 9 straight quarters, as was reported today in the States. So there are signs of breaking. The Fed does want to take stock of the cumulative effects of its tightening. And so in that sense, it's water under the bridge. But Andrew, the biggest reason it's water under the bridge for investors is because we have to think about interest rate hikes as tough love, medicine, if you will, to cure a problem that ailed markets for some time, and in fact still continue to affect them, given that major equity indices are still not back at their old highs. They're performing well lately, but they're still not back at their old highs. And so I've often thought of Fed tightening, ECB tightening, et cetera, RBA tightening as tough love, because imagine a scenario where they do the opposite. They ignore the inflation problem. Of course, this was the feeling that many investors had when the Federal Reserve was saying that the inflation acceleration was transitory. So it was a good thing in a sense that the Fed became the cop on the beat to arrest the problem. And so what I'm getting at in the final words are that sure, there could be another hike or two. We don't think so, but it shouldn't matter too much in terms of portfolio construction, because if there are more hikes, if there's another one or two, it will be for reasons that ultimately are good for markets in the sense that they will foster price stability, generate better economic activity. This isn't to say that things can't weaken along that path in certain markets, but in the end, it's better that the central banks stay on the job.
So, Tony, let's talk about portfolio positioning then, in particular as far as bonds are concerned, of course, given that's where you're at. And just how attractive are those bond yields looking, given where we've seen interest rates go to this point?
Today, the Bloomberg Aggregate, which is a market-weighted index that includes U.S. Treasuries primarily, since it's the biggest part of the U.S. bond market, mortgage-backed securities, and corporate securities, both almost equal weighted around 25% of those indices, with treasuries around 40. The yield is about 4.9%. That looks good relative to history. Looking back the last decade, it's about 2.25 points higher than that. Looking back 20 years, it's about 1.5 points higher. Looking back even further, 30 years, it's about 50 basis points higher. So there's a significant increase relative to the past in terms of these yields. So it looks very attractive on that basis. But that isn't enough, of course. For yields to be attractive, one has to have a view on two things particularly. One, expected inflation, and secondly, expected volatility. On expected inflation, the markets have rendered their vote. You see this in the inflation asset markets. The bond market priced for the Fed to engineer a 2.3% or so inflation rate eventually over a 10-year horizon. So that seems to suggest these yields near 5% for high grade securities is pretty attractive. Secondly, relative to volatility, no one can really predict how volatile markets can get. But if the Federal Reserve stays resolute, and that's one message that Chair Powell looked to send this week, then ultimately that can dampen inflation because it keeps inflation low. And of course, low inflation is what can generate lower bond yields. And so on those measures, yields look quite attractive. And the final word I'll say is when thinking about yields, many will ponder whether this is the right time, but blink and you may miss the bond rally because it tends toward the end of a hiking cycle to happen quickly when it does, and no one can predict when that will be. Market timing is never really a good idea for investors in the bond market, but you don't want to miss the returns that could be made in bonds from price gains that occur when yields eventually decline.
So, Tony, more specifically, which areas are actually favouring at the moment when we're talking about fixed income?
Well, a lot of what I just said, Andrew, relates to core bonds, and these are the highly rated instruments like treasuries, mortgages, corporate securities, investment grade securities. So one way to think about it, though, is in terms of risk factors, duration. So should an investor purchase a T-bill at 5.5%, or a U.S. Treasury, a 10-year at 4, or the compilation of the securities I mentioned, treasuries, mortgage, and corporates around 5? We would suggest the latter makes sense because playing the money market game, well, it tends to run out. And looking back over the last 40 years, these core bonds with an average maturity of around 7 years have outperformed T-bills about 90% of the time, and by a significant amount over a 3-year period, call it around 3 percentage points, because, of course, during a multi-year period, there's a chance at price gains in these longer maturities when yields decline. So in terms of risk factors, we want a little more duration now, want to move a little bit away from very short end. Isn't to say that it's unattractive. In fact, 2-year treasury is becoming increasingly attractive at a yield of around, when it's around 5% or so, because we think the Fed's near done. But in terms of thinking about portfolio construction, you want to move out. Andrew, and finally, I would add in terms of specific assets, we strongly favor agency mortgage-backed securities. These are those pools of mortgages that are backed by the U.S. government. They're yielding levels that we haven't seen since the global financial crisis. Call it about 160, 170 basis points over treasuries. Significant spread, almost equal to where it was during the GFC, and about double from what's normal. These are highly liquid instruments that it's a way to toe into credit and spread products, as they say. So that's another area that we highly favor. Final word is dabble a little bit for diversification in the emerging markets, specifically in currencies, because that's the liquid proxy for gaining exposure to those markets, generally speaking.
Can you be a little more specific there when you're talking about that dabbling in those emerging markets? Where are you looking?
Well, we don't like wagering on a single currency, because in a single currency, there's lots of volatility typically, and you can douse that volatility with a basket of various currencies. And this might include today Brazilian real, the Mexican peso, and I've just highlighted 2 liquid instruments, and a few others in Latin America combined, and even some in Southeast Asia, including the Thai baht, the Indonesian currency, and of course the Indian currency, the rupee, given lots of good news about their long-term economic prospects. So a combination of those currencies in a climate where inflation rates are falling in the emerging markets, and a climate where the Federal Reserve and other major central banks are expected to stop their interest rate hikes soon, will tend to favor those currencies which are performing well of late.
And Tony, volatility, of course, that was characterised last year when we took a look at interest rates. Is that over now? Or should we still be cautious?
Well, thinking about last year to this year really quickly, of course, the reason for the volatility had a lot to do with the market thinking 1% for the US policy rate turned out to be 5. Markets entered this year thinking 5-ish, and it's going to be a little more, but think about the miss, it's much smaller. So it does seem that the the interest rates, and inflation too, is becoming less volatile. So we're a little bit less worried about it. And the final point to make, though, is it seems that correlation between bonds and stocks are moving back to traditional levels, meaning when we see weakness, and it hasn't been of late, but when there's weakness in the equity market, the bond market tends to strengthen, and vice versa. And it's probably why, perhaps, of late, U.S. bond yields have been rising. So volatility is far lower, and it has a lot to do with the points I made earlier. This confidence in the ability of the central bank to produce and engender a climate and foster of price stability. It's vitally important to keeping volatility down.
Tony Crescenzi from PIMCO. That is the Global View this Friday. Stay with us. The Open is up next.